Madhu Kela of Reliance Capital, and he believes that markets would focus more on reforms in the budget session rather than Budget 2013. In a chat with Nikunj, Madhu maintained his cautious stance on the market and recommends investors to create a balanced portfolio.
What is the market performance over 20-year period? You know, what happens 2 months prior to budget and what happens 3 months later than budget. You will come to the same conclusion. And I've got a seat for you. I will give it to you. That. So basically, budget, and this time around, thanks to Mr. Chidambaram going completely on a road shows, and he's been much more transparent. So even the excitement which used to be around for those numbers, whether it is going to be 5.3% or 4.8%, I think that is given.
Cat is out of the
bag. So if any disappointment, the market will be very disappointed. But if those numbers are delivered, then people know, okay, we knew it. He had already told us this. So this time in budget, actually, I am looking at more qualitative factors rather than these numbers.
Give me an example of that.
See, the qualitative factor is rather than budget, I am looking at budget session. What happens in the budget session? Are they able to pass through the insurance bill? Are they able to pass through the pension bill? Are they able to pass through the land acquisition bill? Because some of this, after what they have done in the last 6 months, some of it is expected by the market. And but for this recent helicopter event, which I am not on top of, but I think it was logical to expect that these things will go through. Now, whether that goes through or not, whether we have a clear-cut roadmap for DTC, again, this has been hanging, there's been reference of DTC so many times in budget speech, but do you have a clear-cut roadmap for DTC? Do you have some more clarity on GST? So these are softer issues which will build confidence for the overall reform process in India and overall governance in India. So I think, to my mind, these will be more important than even if the fiscal deficit was 0.1% here or there. This time around, I don't think it is going to have a very meaningful impact in the market.
Do you think we could be in for a strong correction after the budget?
I don't know. Trust me, I am saying, but I am saying, if not after the budget, maybe it could come in March, maybe it could come in April. As I told you, today, from a liquidity standpoint of view, the only source of capital is FI, and I am very uncomfortable.
Which is very dangerous.
That's why I am very uncomfortable with that fact. And I don't see domestic institution, in my opinion, has been very aggressive seller. A, because a lot of public sector companies had come, so participation was required, some of it was very attractive. B, you have a huge redemption of all this, even from insurance companies and mutual fund. I feel that, at some point of time, that will get bottomed out in the next 3-4 months. And I'm getting some early signal by my interaction with various people that maybe by March, April, all the mis-selling which happened in ULIP, maybe we'll come to the worst maybe behind us.
So that could be the turning point.
That could be the trigger point, and that is when we have to evaluate. Now, that doesn't mean that once you stop the selling, that means the day after tomorrow, the money will start coming all over again. So I am saying, that is the trigger for the markets actually to bottom out. So it could actually coincide wherein you have these domestic institutions redemptions peaking out and you have some outflow from the budget, and that could create an interesting opportunity in the market.
Now, since the finance minister will be juggling a lot of balls, from a capital market perspective, what exactly can you do?
I think the most important thing which I am looking at, Nikunj, is, what does the finance minister do apart from the softer part to encourage saving into financial assets rather than in investment avenues like real estate or gold. But that is the fundamental problem of India. On one hand, your saving has gone down from 37% to around 29% now. On the other hand, whatever saving you have, it is still going into assets like real estate and gold. So it is in the near term, it is unproductive. So I am looking at what is it which the finance minister will do to increase the saving in financial products. Now, a lot of things can be done. The one, you allow pension fund to invest in equities. You may start with 5%, but that's a huge encouragement. The other thing would be that infrastructure bond, which was having a tax saving status. They may come back. And you say, instead of 20,000 rupees, I'll allow 50,000 rupees to be invested in infrastructure bond. So whether the money comes in banks or debt or equity, as long as it comes into financial product, I think it will be a big positive. And that is one single most important thing which I am going to monitor this time in budget.
What is the directionally where things are headed, rather than looking at an absolute number?
Absolutely, absolutely.
You're bearish on gold. Why is that? Housewives who are watching this show, they may not appreciate that.
Yeah, I think I would like them not to appreciate it. And I think, see, what has happened in gold in last 6 years has been one of the best performing asset class. But we have to understand on what backdrop was the gold prices gone so high. One backdrop was that the world will disintegrate, America will collapse, Europe will disintegrate, there will be many countries, China will go through a huge slowdown. That was the fear which was there in the world. So even when I am sounding cautious, I think the worst of that fear is behind us. And the proof of the pudding is in the eating. You see why has the gold prices gone in last 1.5 years. And this is what I've been shouting. That just because gold has been the best performing asset, this is not the time. The best performance is behind us. It is not ahead of us. And I am willing to, thumb the table today and say, it is very unlikely that in the next 5-6 years, gold will outperform tax-free bonds in India.
That's a big call.
Yes, a big call. I am saying 8-9% appreciation year after year for next 5 years. Looks very unlikely. You look at the history of the gold prices. What has happened before this before this rally? Gold prices cumulative has gone up only 3% per annum for the preceding 50 years before this rally started.
How much do you think index could give on a CAGR basis, on a 5-year basis?
I think it can still give 15%.
Which is a big call again, Madhu.
It can. I am saying it is, again, equities have to be viewed in the context that 5 years you have not made no money. While your earnings have grown 50% on a 5-year period, your index is virtually at the same level. So why it can't give you 15% CRG if this policy momentum keeps on track and globally things are not great but benign.
So where will that ultimate trigger when will that ultimate trigger, or where will that trigger come from?
The trigger will come from the price only, Nikunj. As I have said, in the market, either you get great news or you get great prices. I think right now the news is great, but for an investor like me, the prices are not great. So my trigger is only the price. If the price comes to a level where I can see a clear risk reward disproportionately in my favor, that is the biggest trigger. And then lot of triggers will automatically unfold.
Let's understand some key sectors. Now, you favored pharma in the past.
Yeah.
Pharma has done exceptionally well in last 2 or 3 years.
That's right.
Are you still hot on pharma stocks? Because so far they've delivered.
Yeah. I feel that, pharma will continue to be a story of a portfolio. See, when we say that we are very bullish, a lot of the viewers may misinterpret it. I am saying you need to construct a proper portfolio, proper diversified portfolio. Then it is about where are you extremely cautious, so you have significantly underweight there. Where you are more optimistic, you have significantly positive. So even in our mutual funds or insurance, which I don't day-to-day look at, but we still have a significant overweight call on pharmaceutical because of the overall structure of the market. And we believe on a stock-specific basis, pharma companies will still deliver good returns.
Is it time to align now with global export-oriented sectors at a time when global economies are reviving? And your view is that globally also the worst is behind us. Do you think in the near term, pharma, IT, export-oriented companies, they could do better?
I think that, again, I made a point last time that, IT, to my mind, was an overweight call. Fortunately, again, that seems to be working. So there's no harm if our overall pitch is that market may give better opportunity. Clearly, the defensives tend to outperform. And particularly, I'm not very excited. I was never excited about FMCG in the last 3-6 months, purely because of valuation and purely because of where the valuations have got stretched. But I think, over the years, what I have learned is, having a sector call is very important. But picking a right company in the sector is even more important. Again, you look at auto sector has done very well. But if you're invested in Eicher Motor, you've really made money. But if you're invested, unfortunately, in Escorts, you've actually lost money. So I think taking the sector call for picking a stock is very important, but picking the right company in that sector.
Will that be the theme going forward as well?
I think so. And I think, a lot of people are calling this a stock picker market. I agree with that. But I think making money in 2013, even on a stock picking basis, is going to be far more tougher than what it was in 2012. So 2012, even if you woke me at 12 o'clock, I would have 5-10 ideas which I could rattle down. and told you that this is what I like. Today, on top of my mind, I can't rattle 10 ideas which are very good on a risk-reward basis.
Let me give you 30 seconds. You can think and tell me some names then.
As I said, I can't rattle today. So markets are clearly, more challenging than where they were in 2012. And we have to be very thoughtful about where we put our money. But it has to come from bottom-up investing only.
Do you think somewhere monetary policy this year could disappoint us? Because one basic pillar on which markets have rallied in last 6 months is that Reserve Bank of India will cut rates. But if I look at the latest communication from Reserve Bank of India, they are insisting that inflation is more important than growth.
Actually, to my mind, now for everyone, growth eventually has to become more important. But I think from a central bank perspective, they will always be very concerned. But I agree with you. I think the beginning of the year, or maybe in somewhere in October, November, there were larger hopes about a larger rate cut, which was being built for 2013 as a whole. I think that has diminished somewhat. So people, I think, and that again partially is reflected in sectors which are rate sensitive, whether it is real estate or whether it is public sector banks or whether it is, auto companies, which are infrastructure companies. That is again reflecting, the market is already telling us that what was restored in 2013 is unlikely to happen.
What has differentiated Madhu Kela from others is that you've always believed in new ideas. You've always believed in betting big. So which sector or which business or which group will now throw up the next set of winners? Because in markets like they say, the courses never change, but the horses do change.
As I said, Nikunj, my still bigger theme is that I am looking at bottom-up companies which are going to come from larger sectors. So one learning which I've had, I have stopped following very, very small companies which are from unrelated sectors, because there you put too much effort. But I think, and there again, if you look at in financial sector, supposing, financial sector will be a great sector. But there, that is where I'm looking, who is the bear market survivor in the financial sector, who have gone through the last learning of the bull market. But there's a lot of opportunity which lies ahead of him. So I think it's bottom-up investing, but this is clearly not the time to bet big, as you said. Now, so I don't have anything which I can tell you confidently today in the market that this is where I'm willing to put my house and buy this stock.
Are you saving something for the next interview?
Yeah.
Okay, before we wrap, final question. Yeah. For those who are watching the show, how can they benefit from your wisdom? What should they do?
As I said, this is, I think I made three or four big points. A, people who believe in me, India, or the broader story, be cautious that don't put 100% of your saving in gold. B, I'm making a point that don't put 100% of your saving in equities either. Make a proper balanced portfolio and keep some dry powder in your back pocket. Eventually, equity is the only answer to really combat inflation of 6, 7, 8%. So basically, if you put your money in equity, 40-50%, and I am not getting into a debate what age you are. I think in any age, at the right time, you can take risk in the market if you have a medium to long-term perspective. So I think I've given enough